This is Satya of Cirrus Research. Welcome to this episode of Market Conversation. In this episode, we walk through the outlook for 26. Generally, a more defensive posture, given the degree of speculation. We underscore the rotational nature of the markets, the fact that the markets are broadening, whether you're looking at the US versus overseas, whether you're looking at US large caps versus small and micro caps, whether you're looking at AI, chips versus downstream. We think this will likely continue as we go through 26. We hope you enjoy this episode. Thank you.
If you look at the overall backdrop, on the surface, we've got a stabilizing GDP, less hot inflation comparisons, and an easier Fed. Effectively, on the surface, everything looks good. That said, the pickup in volatility seen in the fourth quarter, driven by an overly speculative market, investors questioning how many rate cuts there were, coupled with AI spending nervousness, this backdrop, we think, is unlikely to abate in 2026. In addition to a crowded market driven by leading AI stocks, speculation has been running high in the US, surpassing levels seen in the internet peak of 2000. This will continue to force a more broadening across and down the market cap spectrum. As seen in most of 2025, key developed markets outperformed, with emerging markets as well as commodities such as gold breaking longer-term trends. The broadening in the US is also occurring at the AI level, as downstream AI firms posted incredibly strong gains in 25. Additionally, small and micro caps since April, the market bottom, is also really reflecting asset allocators wanting to diversify and limit the overall valuation risk and market contagion. This rotational market will continue to broaden as we go through 2026. In this call, we'll walk through ways to temper the risk and possibly take advantage of the twists and turns. Let's get started. So this chart here represents what we call is really the risk clock. It's got two axes, effectively, the 6 o'clock and the 12 o'clock readings. At the very upper part is what's labeled as extreme optimism. And in that world, what we find to be a very, very challenging period is when risk appetites are especially high or well above normal, and when markets are especially crowded. By chance, the last few months, the US has entered this chapter, effectively that midnight reading, telling us that for buyer to beware. Now, to interpret this, what we're looking at is effectively when you're in extreme optimism and very crowded markets, effectively the forecast from these models suggest that subsequent periods, momentum factors break down, value and quality factors tend to lead, effectively leadership reverses to a point where you've got no leadership. By the time you get to the 6 o'clock reading towards 9, you start to see a new, let's say, refined leadership, where you get to a point from the 9 to midnight reading again to where leadership forms and you get back to hot stocks, high beta, et cetera, kind of where we are today. So this reading is so extreme that it is forcing us to be much more defensive. As a result, in terms of the portfolio follow through, as most of you know, we run a series of growth portfolios and a series of value portfolios. And they're skewed on two axes. One is just effectively levels of risk and fundamental visibility. So if you look at the upper tier, when you're looking at the growth segment, you've got on the left axis, on the left side, you've got the most aggressive, effectively growth strategy, all the way to high quality growth being the most offensive. Somewhere in the middle is the GARP portfolio. And on the value side, we've got from the most cyclical, which I've called deep value, out to the quality value range with relative value in the middle. If we're right that you've got this very speculative period, and even with a decent economic backdrop, this environment would suggest that you want to be erring towards more earnings visibility, not less. You want to err towards some valuation protection, not less. Let me go through a couple of the key models that are really driving this call. Risk appetites remain very high. This reading is effectively what we call the CRX or Cirrus risk score. It's an amalgam of about 6 or 7 factors that we sum up. Bottom line, when we see this reading well above normal, the subsequent 6-12 months, the conditioned returns tend to be well below average. And in fact, when we see the readings well below normal in that sort of heated period of fear, in those instances, you tend to see the highest expected return over the subsequent 6-12 months. In other words, this is a classic contra model. And so whenever this gets up to this level, we get nervous. And so this is why we begin to sort of lock down, play a bit more defensive when we're seeing this reading. What's super interesting, though, is the last time we saw a world where we had the risk appetite spike to highs and market crowding was back at the end of 2020 as we were backing away from the at-home trades. We had a reopening trade starting, and you had a massive sort of fallout with the sort of at-home stocks. And so where we're at today is, again, a very, very crowded marketplace. We all know this. It's basically a handful of stocks behind NVIDIA. And that said, we've seen some massive rotations in there, but nonetheless, these readings are still very exaggerated. And given the sort of forward numbers, this tells us that we want to be very careful here. In terms of the speculation readings, the crowding readings, we bring this together with the credit markets. We bring this together with equity valuations. The stock bond allocation that we run, which has been very effective. We've been running this. There's a 30-year back test, but we've been running this for out of sample over 5 years now. This reading is actually broken through. The longer term average is about 49% equity allocation. We're now down at a 13% equity allocation. Bottom line, it is starting to effectively warm up to the bond market more than anything else. So what is beneath this, clearly overly speculative periods, super crowded markets, and rich valuations. These things tend to put a negative bias on the equity outlook. So I don't think we should be shocked by this. One thing I've got to say, though, is this model has been really pretty much on spot. The back tests are terrific. If they weren't, we wouldn't publish it. But in the last 5 years out of sample, these readings have really, really saved us and helped us really forge a better path. So, we definitely take some heed to this reading. If we step back for a second, looking at 2025 numbers, and this is really hot off the press, we've just pulled together our numbers for the upcoming performance piece going out. At the heart of this, the U.S. actually did quite well. However, what you're looking at when we look at all these other key markets, Latin America was north of 50%, Canada was up over 30%, Europe was close behind, and so on. And then you've got the US down at the 15, 17 handle. Moral of the story is that, and yes, there are markets that have underperformed as well. So we've got India which is weaker than the US and some single markets. That said, when you look at markets, Korea, South Africa, those markets were incredibly strong. Moral of the story is that this broadening in equity allocation has been underway all year. And what we suspect is a lot of the setting has not really changed. What you've got is a fragmentation of trading partners. We don't think that changes. I think the Venezuela event probably underscores the kind of separation that's going to go on. As a result, in a world where markets and relationships are breaking, in that world, financials assets get more challenged. Real assets matter. If you look at the sort of attempt for most central banks to, let's say, limit their dollar exposure, a lot of that was born through not just a weaker dollar for the year, but also gold prices rising higher and higher. We don't really see this changing because the sort of global sort of relationships that are at play here, they seem to be really up in the air, maybe more so now than it was just 12 months ago. But Nonetheless, this is very telling, a very strong equity market. I would argue that the U.S. was incredibly resilient given the headwinds we faced really at the first quarter of the year. If we look now, what I just went through was across regions, across markets. Now let's go down vertically from large down to smaller stocks. What you'll see is that really we've got a broadening that's gone on there as well. Both small and micro cap stocks have outperformed year to date. What's shocking to me is from the April market bottom, the Russell's up 42%. The Russell microcaps are up 61% for that period. Note that gold is also up sharply, as well as emerging markets, all breaking their longer term trend. So the question is, what's going on here? And at the heart of this is that investors are truly really diversifying. They're looking for growth. They're also looking for some valuation protection. And at play is also the global asset allocator that is genuinely nervous to continue to add to dollar exposure. In fact, the broadening that we've been flagging and discussing, what you'll also notice is that played out as well in the AI verticals. We had published this over a year ago and then refined these indices earlier last year of AI downstream plays. Now, the AI downstream plays are broken up into two parts, infrastructure and applications. What I think is important to recognize is as much as the upstream, the semis, which is effectively chips, it was up sharply at 47%. Not really to be mistaken, though, that it was filled with a ton of volatility. That said, when you look across the infrastructure groups and even the applications, you'll notice that the AI theme is indeed broadening. I mean, I'm not sure if anyone has missed the idea that maybe there are going to be more data centers, that power generation is going to be crucial for these applications to really take off, and cybersecurity is also participating. What you're notice, though, is that this area, this broadening that's going on, I really don't think it changes. A couple of ancillary factors that we've got to bring into play here, which is when we look at beta. Now, beta is a funny factor, depending on which year you're looking at beta. I am not sure what beta can hold or what's in there. At this point, though, when you look at the constituents of the high beta basket in large cap land, for instance, it feels exactly right. It is really chock full of AI exposures from chips to applications. And it's also got some large bank exposure. After all, I think most investors are expecting the underwriting cycle to really pick up here off of the AI run. So what is disturbing about this is that the beta factor has performed incredibly well the last 1-2 years. In fact, when we look at it through all of 25, sorry, the large cap beta factor was up about 27% or so. Now, what is striking to me is in the last couple of years, when we talked about leadership, the most dominant performing additive factor was trending, price momentum. Look at it this year. Large cap price momentum was under 5% for the year. This is a big deal because what it underscores is the rotational market that we happen to be trading in. That in fact, factors like value outperform momentum. And maybe the greatest irony that I've seen in a lot of the data this year is this single plot point here about business momentum. Let me define business momentum for you. It's effectively earnings revisions plus some trailing income. But bottom line, analyst forecasts outperformed sharply this year of all of the 4 key pillars that we run for alpha signals. This is really unheard of when most people tend to question, sell side analyst estimates. But this year, it worked really well. In other words, some measures of trending fared well. But the turbulence that we've seen, the best example of this is really what happened in the fourth quarter. That really did shake to the core which direction we were going in. And so my suspicion is that this is not over. And that's why we are likely to play a little bit more defense, look to broaden out our bets, and as a result, inflate some other assets. When we think about the fall correction, November was especially dramatic. And I wanted to pull this up because when we look at the breakout of AI, when AI corrected, notice how all the components broke down. But to get a feel as to what high beta risk is, the alternate energy group, the nuclear bin, in a single month was down 14%, while the chip spin, the AI chip players, they're down about 8%. In addition to that, cybersecurity was down about 15%. Moral of the story is that this broadening of the AI thesis is underway, but what we've got is a great deal of volatility that's going to come into play as investors question how aggressive should AI spending be? Have we spent enough? And heaven forbid a slowdown surfaces at some point here. So, moral story is that this is a fairly challenging period that we're entering in. In terms of what's driving this, when we look at the valuation of markets, whether it's within the US, whether it's cross markets, we'll see the same thing. The large mega cap multiples in the US, for instance, are now really north of 4%, 4.5%, 4.5 times on an EV to sales basis, whereas the mid, smaller cap groups are more like 2 times. This gap is historic. We have this data going back decades. And in fact, when we go across regions, to some degree, we're seeing almost the same picture. So when we step back and look at the asset allocators looking to lower dollar exposure, some of it was not necessarily a pro-con US call. It was just literally more uncertainties on the horizon. I'm going to batten down the hatches. I'm also going to lower my multiple. Let me just take some money out of the large mega caps and diversify. And bear in mind, $1 out of the large mega cap trade in AI, for instance, is probably $10 or $100 in small or micro cap stocks. So it doesn't take an awful lot to cause markets to really react and react in a strong way. And so I think when we look back at the year, it's impressive to end up the year the way we did. And at the same time, the turbulence that we're starting to see, I think it is a sign of things to come. To drill down a little further into this sort of like AI subcategory theme, one area we focused on a lot was industrials. It's been really the last 4 years, we've had a very bullish outlook. It started with the reopening and the need for infrastructure, and then it led into the need for downstream AI from data centers to power generation. And what we're finding, though, is that in the last 6 months or so, what we're seeing is a dramatic move among some of the smaller names. So much so that we're now, for the first time in several years, getting to a point where the small cap market is now getting crowded. And that is something I haven't seen in a while. What we've seen is really fits and starts of large cap crowding without the smaller cap market participating. So this is something that I think is a big deal. And to get you a feel for, sort of crowding numbers, when we look at key industries and how they perform for the year, when we look at wireless telecom, that was up 170%. Gold and precious metals were up 160%. Steel was up over 80%. Electrical equipment was up 77%, and so on. Microcaps, aerospace defense up over 70%. Communication equipment up 72%, and so on. The bottom line is that it's not all AI. And if it is, it looks as if the bang for your buck in AI is probably occurring in the downstream plays. So as we become more sure-footed about where the AI industry is going, if you go back 3 years ago, no one trusted it, so therefore it was a pick and shovel game. In other words, I don't know if this thing's real, so I'm going to buy NVIDIA. 3 years later, when we look at the 2025 numbers, the downstream investments are here and they're not going away. And so we think that that's really what's likely to occur here. And that's why trending factors were not impressive in the large cap area, because investors are really torn about how to play the AI trade now. And I suspect that will continue to be that debate will continue as we go through 2026. I think one thing that I failed to mention though was that the high beta basket is a way of fine tuning the risk here. Note that the multiple in high beta, large cap high beta basket is about 6.5 times EV to sales. The last 10 years, that multiple averaged about 3.4 times. So what we've got is, quite a bit of risk in a really cleanly defined variable that's not often that clean. But when we look back to the small cap market and the broadening that's been going on, that's been quite dramatic, industrials are starting to surface because they've really, really benefited. One of the largest clusters of the momentum basket in small cap and micro cap land are industrials. Now, this flies in the face because what we're seeing when we look at the government data on CapEx, when we separate the accounts out between technology spending and industrial spending, the technology spending component has started to reaccelerate in the last couple of years, whereas in just the last few quarters, the industrial CapEx data is starting to slow. So what we've got is remarkable performance that we've seen. Small cap industrials, for instance, have gained about 70% in the last couple of years, about 31% with the pullback in the fourth quarter for 2025. Moral of the story is that this is, very disturbing to see the spending data not track as it should. I don't have all the answers to this, but why I'm taking it more seriously, because you could say that, hey, if AI spending is going to accelerate in tech, it's got to fall into data centers and power generation. So engineering and construction companies are still going to benefit. I agree, but here's the rub. When we look at the forward estimates for industrials, large versus small, they're both starting to roll off. So the forward estimate revisions have started to go negative. So we're now looking at from maybe near time highs of 7 out of 10 estimates changed were being raised about 6 months ago to now roughly 1 and 2, and maybe even less than that. So bottom line, the forward guidance is really starting to become a challenge. So if you don't have the fundamental spending forecast there and you've had a run up in the stocks, it's really hard for us to sort of defend, that move at this point. So what you're looking at here are the fairly dramatic moves. This is the large cap run, this is the small cap industrial run, and this is the micro cap industrial run. So moral of the story, these numbers, they're quite dramatic. Drilling down into industrials, construction and engineering has been by far the biggest beneficiary for a lot of good reasons because of its relationship to power generation and data centers. When we look at the smaller industrial multiples versus large industrial multiples, there's some interesting disparities here. This is multi-decade data. Bottom line, the small cap industrials have really climbed. In fact, looking at the micro cap industrials, those numbers are also quite exaggerated. Whereas the large cap comparisons, they're more reasonable. So not that this is a death knell for industrial spending, but what we are noticing is that it's gotten incredibly speculative, that unless we see sort of like a reacceleration in the CapEx trend, which I think we should, but it doesn't have to be a straight line. When you've got those two elements and this rich comparison, you probably want to buy some protection in this vertical. So that pretty much wraps up what I wanted to cover. At the heart of this is that we've got a rotational market and a broadening market, both in 2026. A lot of this is driven by the international market dominance in 2025. I think it'll continue as central bankers are concerned about their dollar exposure for a whole host of reasons that's probably beyond my knowledge set. But I don't see that changing. The broadening that I refer to, it's across markets, it's intra markets, it's vertically down AI. So a lot of that started in 2025, I think will continue to run in 26. Just a quick, curious statistic. In the last few days of trading, the Russell's outperforming both NASDAQ and the S&P. So whatever's gone on in the fourth quarter in the last 6 months or so, I think that is continuing. So in terms of playing defense, we've talked a lot about looking for more earnings visibility, playing up on more defensive sectors like healthcare, like utilities. I don't think we have a choice when our risk measures are flashing as strongly as they are. The extreme beta readings that I flagged, I think this becomes a really good, effective indicator for trimming portfolio risk. As I said before, I don't buy that beta is always a good, clean proxy for risk in markets. I think sometimes it gets very confusing when you look underneath the hood. But in this current period, given the run-up we're seeing, given the exposures in the baskets, uh, it feels about right. And in fact, it's worked. In the fourth quarter pullback, the most dramatic breaks were high beta. It went down about 12, 13%, compared to most of the other factors down 5, 6% or so. As we said, downstream AI that began to cook in 2025 will likely outpace upstream AI and chips in 2026 just because of the law of large numbers. As the spending continues, and I don't think we debate that, I think the risk to the AI chip play is that does it accelerate as much as we thought? And I don't know if I think that gets really difficult here. That said, the investment in chips, by definition, you can look through and you've got to have some degree of data center being delivered, improvements in power generation. So that spending, I think, will continue down below. The dominant sort of 2025, industrial sector run, I think we've got to play caution here. This is probably more tactical than anything, but we have seen in a bull market for a certain theme, we can see some pretty sharp pullbacks within an ongoing run.